explain the legal requirements and implications of redemption of redeemable preference shares. Number two, to show the journal entries and also the entries in the statement of financial position for redemption out of fresh issue of shares, profits, and combination of fresh issue of shares and profits. Number three, explain the accounting entries for redemption of debentures. Number four, explain the advantages and disadvantages of share buyback. Finally, shows the entries in the journal and in the statement of financial position for the share buyback using treasury share stock method and also the share retirement method. Okay, so basically class, there are three subtopic under chapter 4. Okay, the first one is the redemption of redeemable preference shares. Okay, followed by the share buyback. Finally, redemption of debenture. Okay, so I'm going to start with the redemption of redeemable preference shares first. Okay, first of all, you need to understand what is the meaning of redeemable preference shares. Okay, so it is a type of shares under preference share. Remember in chapter 2, we learned that company may raise its capital by issuing shares, okay, and by borrowing, okay. So by borrowing can be in the terms of loan from bank, okay, debentures, and also the redeemable preference shares. Even though the name is preference shares, but okay, it is classified as liability. Okay, please take note here. Okay, I'm going to show you. Okay, as I mentioned, even though the name is shares, okay, but in the accounting component, it is classified as liability. So in the statement of financial position, the redeemable preference shares will be recorded under the liability section, because redeemable preference shares provide a mandatory dividend payment. Okay, why do we say it is a liability? Okay, let us look further in this explanation. Okay, this share is liable to be redeemed at a specified date with a determinable amount once it is issued by company. So when these shares is compulsory to be redeemed, okay, therefore there is an obligation for the company. The obligation shows that it will become the liability. The dividends payable on this share are considered as expenses, meaning it will be recorded under finance cost and recorded in the statement of profit or loss. So the first thing that you need to know is that you need to know the definition of the shares, okay, where the shares is need to be redeemed at a specified date, okay, with a determinable amount. And the next thing that you need to know is that the dividends that attach to this share, okay, will be classified as finance costs. So it is an obligation for the company, okay, to pay the dividend to the redeemable preference shareholders. And it will be expensed in the statement of profit or loss. Okay, let us look at the process of redemption of redeemable preference shares. Okay, after we know what is the redeemable preference shares, is a type of shares, but it is classified under liability in the statement of financial position due to the obligation for the company to redeem it in the future at a determinable amount. So now let us look what is the meaning of redemption. Okay, actually redemption is a part of process. Okay, so this is what we should learn in chapter 3, where the company may borrow or may issue shares to raise the capital. So assuming the company has already issued the redeemable preference shares, okay, meaning the company already obtained the money from the redeemable preference shares, okay. So this is so assuming this is the company, so assuming this is the company, okay, the company already received the money from the issuance of redeemable preference shares. So we assume that we already received the money. Okay, the money will become the capital for the company. So the redemption is where, okay, referring to the methods of returning the cash to the shareholders of RPS. So this is where the redemption takes place. It is a method of returning the cash that you received from the redeemable preference share previously. Okay. So it is like a repayment lah. Meaning, okay, we assume that when you issue the redeemable preference shares, you are borrowing from the shareholder. Now it's time for you to return back the money. That is what we call as redemption of redeemable preference shares. Okay, the price at which the company redeemed this redeemable preference share is already decided during the time of the shares issued. So when you are issuing the redeemable preference shares to the redeemable preference shareholder, so the redemption value, okay, is already decided during this stage. Okay. And the redemption will thus reduce the amount of the outstanding shares and involve cash outflow. So the impact, okay, the implication of the redemption is that you will reduce the amount of the outstanding shares of the company and you will need to make a cash outflow, meaning you have to make the payment. The payment indicates that there will be a cash outflow. So this is what we call the redemption of redeemable preference shares. So by looking at the diagram, I hope you understand the process. Firstly, you receive the money from the issuance of RPS where the redemption value is already decided at this stage. And then redemption takes place is where you return the cash money that you have borrowed from the redeemable preference shareholders. Okay, now let us look of the financial implication of the redemption of redeemable preference shares and the requirement by the statutory. Okay, this is what being stated in the Companies Act 2016. Subject to the um, Section 72 of Companies Act 2016, it specifies that if authorized by the Constitution, a company may issue preference shares which are liable to be redeemed in accordance with its Constitution. Okay, that is the first thing. Next, the company shall give notice to the registrar specifying the shares redeemed within 14 days from the redemption. Okay, this is about the early process. Okay, now this is the most important one. However, the redemption shall not be taken as reducing the amount of share capital. Now, even though you are being consent, you are being permitted by the Companies Act to issue the redeemable preference shares, okay, and which you know that the shares will be redeemed in the future. According to the act, it says that the redemption shall not be taken as reducing the amount of share capital. Now, how that can be happen? Because when you know when you issue the redeemable preference shares, okay, it is a compulsory for you to repay the money to the shareholders, and we know that the implication is that when we make the redemption, okay, we will reduce the amount of the outstanding shares. Okay, however, okay, according to the act, it says that the redemption shall not be taken as the reducing the amount of share capital. You see, okay, there will be what we call conflict here, because the statutory act require that the company should not reduce its share capital, whereas you know the process of redemption will reduce the amount of the share capital. Therefore, how are we going to rearrange it so that we can comply to this statutory requirement? Okay, so according to section 72, subsection 4, okay, the statutory act rule out this following rule of redemption. It says that the shares cannot be redeemed. The shares can only be redeemed if the shares are fully paid up. Meaning that if the shareholders have already paid, okay, the amount of the shares, then only the company can make the redemption. And we have another condition that the redemption shall be out of one of the following. So we have to exercise, okay, this type of redemption in order for us to ensure that we are not reducing the amount of the share capital even though the redemption takes place. In other words, we want to keep intact. We still want to keep intact of the amount of the shares in the company. Okay, so how to do that? Okay, we can choose any of these three. First, we can do the redemption through our fresh issue of shares, or we can choose the redemption out of profit or redemption out of capital. Okay, so let us look further. What do you mean by redemption of fresh issue of shares? Okay, so assuming now we already make the redemption. Okay, this is the process of redemption, yeah? Okay, so this is the process of redemption. But remember, even though it is permitted by the Companies Act, but the Companies Act mentioned that the redemption shall not lead to the reduction of share capital. So how to ensure that even though, okay, when you make the redemption, okay, there will be a reduction, reduction in the share capital, but you can actually replace back, okay, the reduction in the capital. So how to replace back the amount that you have reduced? One of the method is to issue new shares. This is what we call redemption through a fresh issue of shares. So by issuing the new shares, okay, the redemption will ensure that the issued capital will remain the same as before the redemption. So how to do that? The company will make fresh issue of shares, either is ordinary or preference shares, equal to the amount of the shares redeemed. Okay. Now let's say if you redeem out of capital, if you redeem out of the company total to, okay, let's say 100,000 ringgit. Okay, at the same time, you are going to replace this amount, okay, this 100,000 by issuing the shares to the potential shareholders. So the amount that you receive from the issuing of shares must at least equal to the shares that you have reduced. Even though you have reduction here by 100,000, by issuing of shares later on, okay, you might replace back the amount of share capital that you have reduced. So this is what we said, that the proceeds, meaning the value from the shares issued, must equal or tie back with the amount paid for the redemption. Okay, even though you have reduced 100,000 here, due to the redemption, but at the same time you can increase back the value of the shares, okay, by issuing fresh shares to the potential shareholders. So the type of shares that you can issue are ordinary or preference share. Is that clear, class, so far? Do you understand,
Yes,
class?
yes.
Any
Yes.
correspond? Okay, good. Okay, now let us look on the journal entries. Okay, so these are the journal entries for the redemption of fresh issue of shares. Okay, number one, this is the first step. Okay, this is the first step. It's compulsory for you to start with. When you redeem the shares, meaning the shares will be taken out from the company, it will be reduced. So as you can see, we will debit the redeemable preference shares. Debit meaning there will be a reduction in the shares. Why reduction? Because you want to redeem back. Okay, because at the first place, when you issue shares, the shares will be credited. Credit in shares shows there is an increase in the share. But now you are going to debit the share capital account because you want to redeem the share. So once you redeem, the share is no longer in the company because you already repay to the shareholders, right? So debit redeemable preference share capital. Okay, you can use the acronym RPSC. RPSC stands for what? Redeemable preference share capital. And then at the same time, you are going to credit to a temporary account called redemption of preference share. So this is just a temporary account for you to locate the redemption and which need to be repaid later on. Once you already complete the repayment, then this redemption account will be closed. Okay. Number two. Okay. Number two, compulsory for us to record is the payment made to the redeemable preference shareholders. So how to make the payment? You are going to, you can see, we are going to trade off. We are going to debit the redemption of preference shares and then credit the bank. Why credit? Because you make the payment. Once you make the payment, your money will decrease. So this is an outflow. This is what we call an outflow. So once the payment has been made, as you can see, now the shares has been reduced, right? Your number of shares has been reduced, okay? As what we already discussed here, the implication of the redemption is that the amount of the outstanding shares will be reduced and there will be a cash outflow due to that. However, okay, according to the Section 72 of Companies Act, the redemption shall not be taken as reducing the amount of share capital. So here we are. We know that once we make the redemption, the share capital amount will reduce. Okay, but Companies Act mentioned that the redemption shall not lead to the reduction in the share capital. So how are we going to increase it back? How are we going to increase it back? Okay, this is the method that we are going to use, where we are going to issue new shares to maintain back the capital. If you are reducing the amount by 100,000, meaning you are going to add back by 100,000. We are going to add back by 100,000. So in doing so, we are going to do the first method. This is the first method that we are um, exercising. So the first method is by issuing shares. So how to record the issue of shares? Remember, this is what we learned in chapter 3. This is what we learned in chapter 3. So the steps already learned in chapter 3, you just have to replace according to the transaction. So assuming if you are issuing ordinary shares, so here you should record as ordinary share. If you are issuing preference shares, then here you are going to record the preference share. Depend on your question. So how to record the amount, the issuing of shares? Okay, as usual, step number 1, debit bank, credit ordinary share application. So assuming we don't have any oversubscription, we are going to directly transfer the share application to the share capital account. Depend on the type of shares that you are issuing. Okay, class? Can you follow me?
Yes, madam.
Okay, good. Now let us look at this as an example for you to have better understanding. Okay, Seri Iskandar Berhad. This is the company with the statement of financial position as at 31st December 2005. So this is the closing balance for your money at bank, your shares issued and paid up. You only have one type of shares, that is ordinary shares, and you have reserve return profit, and you have non-current liability here, redeemable preference shares. Okay, besides then the redeemable preference shares, in chapter 3 you have learned that another type of non-current liability is the debenture. Remember, debenture. Okay, but now we are going to focus on the redeemable preference shares. So this is the classification of the shares. Remember, even though the name is shares, okay, but we cannot record it under the issued and paid up capital because this is liability. Why is it liability? Recall back just now I have explained to you, because these shares, okay, need the company to redeem require the company to redeem it in the future. So the nature, the substance, what we call it, that embedded in the shares shows that this shares is categorized under liability because the company has obligation to repay it in the future. So the amount of the redeemable preference shares is 2 million in units and 2,200,000 ringgit in value, ringgit value. Okay, in 2000 year zero, Seri Iskandar Berhad had issued 2,000,005% redeemable preference shares at 1 ringgit each. So this is long time ago, okay, 2000 year zero, long time ago, the company had issued this share. So this is the shares that has been issued since 2000 year 2000 year zero, and this to be redeemed. It is to be redeemed at 1 ringgit 10 cent after 5 years. So this is after 5 years lah. So now we are in the years of redemption. We start issuing it 2000 year zero, where remember, okay, when you start issuing the shares, you also need to decide the redemption value. Okay, recall in the first slide just now, okay, the price at which the company redeemed these shares is already decided during the time of the shares issued. So back to our question just now, okay, when the company issue the shares in 2000 year zero, they already decided the redemption value. So this is the redemption value. This is the redemption value. So what happened is that as at 31st December 2005, okay, at the end of this year, the board of directors agreed to redeem all. They want to redeem all the redeemable preference shares, okay, at the carrying amount. So they want to redeem at this value. This is the carrying amount. And okay, this is the interesting part. They are going to issue 5,500,000 ordinary shares of 40 cent each for the purpose of redeeming the preference shares. As we know, okay, the redemption shall not lead to the reduction of the share capital. Therefore, the company already planned that they are going to issue ordinary shares, okay, by 5,500,000 unit for the purpose of the redemption. And the shares that they are they want to issue is fully subscribed and paid for. Okay. So you are required to prepare the journal entries and also the extract of statement of financial position as at 31st December 2005. So now, okay, we are focusing on these shares where this share is going to redeem. How much? They want to redeem all, meaning you won't left any balance of this share. And then you are going to issue ordinary shares for the replacement. Okay, let us look at the answer together. Okay, before we start doing the answer, okay, these are some of the guidelines. As for the starting, okay, students are advised to start by extracting the following information. So this is a guideline for you where to start. First, you need to know the amount of the redeemable preference shares redeemed. As I told you, the company wanted to redeem all. Number two, you need to know the method that to be used to maintain the capital. So we already know that the company will issue ordinary shares. So now, in the journal entry, we will start by recording the amount of RPSC redeemed and followed by the payment. Remember, these are the first two steps in the journal entry. And then, since the shares are redeemed by issuance of fresh shares, okay, then we are going to proceed with the next step, okay. So the next step is to record the issuance of shares as per IPO entry. This is what you have learned in chapter 3. And you please ensure that the proceeds must equal to the amount of shares received. Shares redeemed. So the proceed must equal at least. If you have more than that, then it's okay. At least you must satisfy the minimum requirement. And then what you do next is to update the balance in the adjusted account to accommodate the changes in the statement of financial position. Okay, let us look at the suggested solution as follows. Okay, remember you want to redeem all. Okay, you want to redeem all. So the first step is to record the redemption. How to record the redemption? debit the shares. So you are going to debit the share. Debit meaning you are going to reduce the share. Debit the 5% redeemable preference share capital, 2,200,000, and credit to a temporary account called redemption of preference shares. Okay, next step is what? Is to make the payment. Next step is to make the payment. So you are going to debit the redemption of preference shares by the same amount and make the payment. So credit bank shows you already make the payment. There is an outflow of the redemption. Lastly, okay, this is what we call the replacement. Okay, we are going to replace, okay, the shares that you have reduced just now. Okay, you must ensure that you must get the same amount when you replace. So how to replace? You are going to issue shares. How many shares? You are going to issue 5,400,000 unit at 40 cents each. So the amount, this is the proceed. This is the proceeds. So the proceeds from the share is equal back to the amount that shares you reduce. 2,200,000. So you are going to credit the ordinary share application, and then you are going to close the ordinary share application and transfer to the ordinary share capital. Remember, you are issuing ordinary shares. So let us update our statement of financial position as follow. So for the bank, okay, previously you have 60,200,000. Okay, you have to look for any transaction related to bank. Okay, number one, number two. So number one here, credit meaning you minus. Okay, debit here meaning you add. So there are two additional transaction here. Number one is to minus. Okay, this amount that you minus, and number two is to add up. Okay, this is referring to this step. Next, issued and paid up capital. You previously you have ordinary shares. Okay, let us look at the previous software. Okay, you only have 50 million ordinary shares. So now your ordinary shares has increased to 55,400,000 because you are issuing the new ordinary shares here. That is the reason why, okay, become uh 55 million. Previously 50 million. So you add up with the current issue was 5,400,000, so it become 55,500,000. And as for the value, okay, the value previously the amount is 25 million. Okay, this is the old one. Okay, once you have a transaction here, so what you need to do, you have to add this 2,200,000. This one you have to add. Okay, then let us proceed to the other one. Okay, what do you have? Previously, you have, yes, you have return profit here and you have non-credibility. Okay, as the return profit, okay, since there is no adjustment for return profit, so the amount will remain the same, 33 million. As for the non-credibility, since you already redeem all, so this no longer appear in your statement of financial position. So there is no balance anymore because you have redeemed all. So this is how the answer will be presented. Okay, class, do you understand so far?
Yes, madam.
Yes.
Okay, good. Okay, next I want to continue with the next method. Just now we are issuing through shares. The next method here is through out of profit. Now this is simpler, okay, more simple, okay, as you don't need to issue shares, okay, but you will take the same amount, okay. Remember when you have reduced, let's say you have reduced 100,000, so you are going to add up you are going to place another 100,000, right? So the way of this replacement is not by issuing new shares. However, you are going to transfer. You are going to transfer an amount that equal to the amount of RPS redeemed from. Okay, this is the location that we are going to take the shares that you redeem. From retained earning. Okay, to the ordinary share capital account. So you are going to transfer the same amount of 100,000 from where? From the retained profit account, and you are going to transfer to the ordinary share capital account. Is that clear, class? Do you understand? Okay, very simple. You just take the same amount from retained profit account and you transfer to the ordinary share capital account. Okay, let us look the same example. Before we go for the same for the example, let us look at the journal entry. Okay, as you can see, the first and the second method are the same as the issuance of share. Okay, these steps are the same. First, you redeem the shares. Redeem the share meaning you are going to reduce the share and then you are going to make the payment. Okay, but the difference is in the step number 3, where you are going to transfer, okay, the same amount of money from the retained profit account to maintain the capital. As for the step, you just have to debit retained earning. Debit retained earning meaning your retained earning will be reduced, and then you will transfer to the ordinary share capital. So the ordinary share capital will be increased. So the amount that you have reduced here has been replaced to the share capital account by the same amount. Okay, you are going to take, okay, the 100,000 or whatever amount based on your question from the retained profit account and transfer to the ordinary share capital. Let us look the difference between the share issuing of shares and between the out of profit. Okay, in this case, you are reducing the shares, yes, similar, and then you make the payment. So how to maintain the capital is that you are going to issue the shares. So how much of shares that you issue, it depends, but however, at the end, you must ensure the amount that you receive from the issuance of share will equal back to the shares that you redeem. So this is the amount that you are going to replace, where you are going to transfer the money from the shares and you transfer to the share capital account. Okay, here your share capital account will increase by 100,000. The money that you get here will be transferred to the share capital account. Okay, so let us look the suggested solution together. Okay, so based on the example 10, okay, we are going to use the same example actually, class, assuming that the redemption is to be made through out of profits. No fresh issues is made. Okay, so similar, the step is we start by determining the shares that you want to redeem. And number 2, you are going to determine the method that you use to maintain the share capital. So this time you are using out of profit. Okay, let us look the suggested solution together. Okay, this is the same. The first one and the second step is the same. However, there will be different here. Okay, the difference is on the step number 3, where you are going to take the amount 2,200,000 and from the retained profit and transfer to the ordinary share capital. Nampak? Even though you have reduced 2,200,000, okay, but you already replace it by the same amount. So the effect is that, okay, this is the implication. Okay, the cash at bank, okay, you only have one transaction here. So you are going to minus the amount. As for the ordinary share capital, okay, the unit is still the same. Okay, it's still the same, because you are not issuing the shares. However, the value will be different. Okay, the value will be different because you have transaction here. Where does this transaction comes from? Is from here. Here, credit shows there is an increase. So increase meaning you have to add. Okay, this one shows the decrease. Decrease meaning you have to minus. Okay, next, the reserve. Is there any effect in the retained profit? Yes, you have transaction related to the retained profit here. Debit shows there is a decrease in the retained profit. So decrease meaning you have to minus. Okay, class, do you understand so far? Do you understand the difference between the method between issuing of shares and out of profit?
Yes, madam.
Okay, I hope you do so. Okay, because we have to follow or we have to comply with the requirement of the Companies Act, even though they permit us, okay, they give permission for company to do the redemption, but the company must ensure that the redemption will not lead to the reduction in capital. So in doing that, okay, the company have to find alternative or method to ensure that they can replace back their shares. So to replace their shares, they can either using the redemption by fresh issue of shares, or redemption by out of profit, or redemption of capital. However, redemption of capital is not to be explained because it's just a matter of there is no journal entry that effect, but okay, the most important that I want to focus is when the company wants to combine, the two method, meaning they want to combine the method 1 and method 2. So now let us focus on how if the company plan to do the redemption by partly of issuing new shares and partly by out of profit. Okay, so this is okay. We recall back the process of redemption. Okay, this is the process of redemption. So now we want to replace the capital that we have reduced. So previously we can choose either method 1 or method 2, right? Now we plan to combine both methods. Meaning to say, if you have reduced your capital by 2,200,000 as our example just now. So now we have to ensure that okay, the proceed from selling shares and the amount that you take from the out of profit should equal back to 2,200,000. So this is the combination of method 1 and method 2, where we have to ensure that the amount of shares issued and the amount that we transfer from the retained profit must equal or must tie back with the amount paid for the redemption. Okay, let us look at the next explanation. Under this method, okay, what the company will do is that they will redeem the redeemable preference shares partly by the issue of new shares, and partly meaning you only take some of it, you don't take the whole, by transferring profits otherwise available for dividends to the ordinary share capital. To proceeds from the shares issued and the amount of profit transferred to the ordinary share capital account should equal to the amount of RPS redeemed. This is what we have explained just now. Okay, next. This is the journal entry, okay, for the combination of both methods. Okay, again, step 1 and step 2 is the same. Okay, remember, you reduce the shares and then you make the payment. But number 3, you can see there is a combination of step 1 and step 2, where this is referring to method 1 and this is referring to method 2. Okay. However, both must ensure that it will, okay, the amount must tie back to the amount of shares that you have reduced. Okay. So as you can see, okay, please look carefully. These are the step that we already learned in the previous slide. Okay, the first one here, debit bank credit share application, is actually referring to the amount of money that you receive when you issue share. Next, debit share application, credit share capital is the second step. When you issue shares, you will transfer to the share capital account. And lastly, finally, okay, the debit retained earning and credit ordinary share capital shows the transaction for the redemption out of profit. Okay, now let us continue example 11. We are still using the example, the fact in example 9. Okay, accept that. Okay, accept that the redemption is to be, okay, we modify the question, partly by issuing 1 million ordinary shares at an issue price of 60 cents per share, and the balance is to be taken out of profits. Okay, and the shares that you issued are fully subscribed and fully paid. You are required to prepare the following. Okay, again, this is the guideline. The first step, okay, we skip on this. We already know this is what we need to Fine. Okay, number 2, you have to determine the method. So the method now, we know that we are going to use partly issuing of shares and partly by out of profit. So here, we need to know how much the balance that we need to transfer, right? So here it says that the amount to be transferred from the retained profit account shall subject to the difference between the amount of RPS redeemed and the proceeds from the OSC issue. Meaning to say that, okay, very simple example, if you are going to reduce 100,000, okay, if you are going to reduce 100,000, so you are going to replace by partly issuing shares, partly of profit, right? Let's say if you have issue shares and you find that the amount, the proceed that you receive is 80,000 ringgit. So to find the amount to be taken out of profit is by, okay, subtracting this value from the shares that you redeem. Okay, this is what we meant, the difference between amount of RPS redeemed and proceeds from the ordinary shares issued. Therefore, the amount that you shall take from the profit equal to 20,000. Okay, so let us look the following answer to have better understanding. Okay, first step and the second step are the same. Okay, now how to replace this amount? Okay, you will issue shares. Okay, how many units of shares to be issued? 1 million at 60 cents per unit. The shares are fully subscribed and fully paid off, so you don't have to reject because there is no over subscription. So the amount that you receive from the issuance of share is only 600,000 yang you already transfer to the ordinary share capital. But you still not enough. If you compare to this one, you still have insufficient amount. So how much is the difference? You will minus these two value. So the amount here will be 1,600,000. So this is the value that you will take from the retained profit and transfer to the share capital account. So see, when you have transferred to the share capital account, okay, these two value has equal back to the shares that you have redeemed. So you have decreased 2,200,000 here, but you already increased back by the same amount by using the combination of method 1 and method 2. So now you are going to update your account, okay, and you are going to adjust in the statement of financial position. So to record the cash at bank, you look for any amount that related to the bank. So you can see here, credit bank here, debit bank. Okay, that's all. So the first, okay, credit shows there is a decrease. Decrease. The debit here shows there is an increase. So you add. Okay, next, the ordinary share capital. Okay, is there any information regarding ordinary share capital? Yes. Okay, as you can see, the ordinary share capital, credit ordinary, sorry, it's not this one. I'm sorry. This one, credit ordinary share capital, and you have two entry in the credit side. So here you are going to record increase and increase. Credit shows there is an increase. Credit shows there is an increase. Okay, what about the reserve? Okay, reserve, do we have transaction related to reserve? Yes. Here we have one. Okay, we have one here. Debit retained profit. So debit shows that there is a reduction. Reduction in the retained profit. Okay, class. So this is the final answer for your statement of financial position. Okay, class. Can you follow me? Do you understand
Yes,
so far?
madam.
Okay, good. So these are the transactions related to the method 1 and method 2. Okay, so if you refer to your practice kit, sorry, your study guide, okay, you will see more example. Okay, for example here, Kinta Perdana, this is actually taken from your study guide, Kinta Perdana Berhad. So if we can go through a bit, okay, this company already issue a redeemable preference shares here, and it need to be redeemed in future. So back to 2000 year zero, okay, this is the information regarding the issuance of redeemable preference shares. Okay, and the company decided to redeem the shares at a premium of 20% in 2000 year 5. So here we are in 2000 year 5. So we are going to redeem the shares at a premium of 20%. Okay. And actually this is the value dah. This is the redemption value. Okay, and then at the end of 2000 year 5, okay, the company then resolved to redeem all the redeemable preference shares. It is resolved that this redemption will be financed. Okay, see here. Okay, here we can see that the company choose to redeem using the combination of issuing shares at 3 ringgit each, and the balance will be taken out of profit. How do I know? Student may ask, Madam, how do you know that this is a combination method? Because the keyword here that shows it is a combination method says that it will be financed partly. Even though the question did not mention the balance will be taken out of profit, but by this word we shall understood that this is a combination method of method 1 and method 2. Okay, let us look for the solution. So recall back, okay, this is the shares. Okay, this is the value of shares to be redeemed. Okay, so first step, we are going to debit the redeemable preference shares 12 million, credit the redemption of preference shares 12 million, and then you make the payment. Debit redemption of preference shares, credit bank. See, when you why do I say there's a temporary account? Okay, when you make the payment, you will debit the redemption of preference shares account. So at the end, you have no or zero balance. So that is why I say that it's just a temporary balance. So to replace the amount of shares that you have reduced, you will issue shares, okay, by 3 million units. So the amount of shares per unit is 3 ringgit. So the amount that you receive is 9 million. Now, you only receive 9 million and you transfer to the ordinary share capital. But you see, it's still not enough. So how to find the, how to, what to say, how to ensure that you will fully replace the value is by, yes, is by add up this method. You are going to take the balance from the retained earning account. So the balance will be 12 million minus the 9 million, and it will be 3 million. So the 3 million will be taken out of profit and transferred to the ordinary share capital. So this is the final balance in the statement of financial position. Okay, so that's all about the redemption of redeemable preference shares. I'm going to stop for a while for this recording, and we are going to continue in part 2.